Okay, welcome everybody to this week's stock analysis. As always, I try to analyze a stock that people recommend to me. I believe last week uh, someone with a YouTube name White Calvis recommended several stocks to me, and I decided to look into New Skincare Enterprises, New Skin Enterprises. They have the ticker symbol NUS. I fill it into the spreadsheet, press enter, and now it will start retrieving all the data. And once it has done so, we can look what we got and start our analysis. Okay, it has loaded all the data. As we can see, it has a very good score. The score indicates how well a company is performing based on its fundamentals, so its return on equity, debt to equity. It checks all these variables and it analyzes them. I mean, many tools out there, you fill in a ticker symbol and you get a whole list of figures and ratios. But the spreadsheet actually goes one step further and actually analyzes all these figures and tells you whether they are actually good or bad or low or inconsistent. I can show you this in the analysis tab of the spreadsheet over here. As you can see, it shows the values, but it also shows, for example, debt to equity 0.1, which is good. And it says here a little comment: firm not dependent on loans, low interest rate risk. So you get a bit more information with it. So as we saw, an 89 out of 100 is a really good score. We see that return on equity is inconsistent. So let's look at the graph to see what's up with that. Well, why it says it's inconsistent is because here it dipped below 15, and we're looking for stable return on equity of above 15%, preferably, because that indicates that the company has above average profitability. However, we do see a big upward trend over the last couple of years, so that's a really, really good sign. Even as high as 45%, that's a very high return on equity. Also a very good sign is that the free cash flow, which is the blue line in this graph, grows as fast as the net earnings. So that is always gives you confidence that this company is not manipulating its earnings. Profit margin is rising. Book value is rising almost exponentially. You see the classic hockey stick shape, as they call it, starting to appear. So that's all a very good sign. Dividends are increasing. Number of shares outstanding are decreasing, which means that they are returning value to shareholders by giving them a dividend payment and also by repurchasing shares. So those are all very good signs. However, if we take a look at the intrinsic value estimates, by the way, this company, as you see, it's in the personal products industry. It's a multi-level marketing firm, and when I read that, I immediately thought, okay, that can be a very profitable type of business, but it is always, for some reason, feels like a bit of a shady type of business. It's sort of this pyramid that they create with resellers and then sub-resellers, and everyone gets a little cut, and they just have to promote these products because the products they're selling are actually personal care products and nutritional supplements. And the thing is that if we, for example, let's take a look at, this is Google Finance, and what we see here, if we increase the size of this chart, you can see it better, that there was this massive drop in price over the past couple of months. So it was at around $135 back in January of this year, and now it's only at, well, the price is $41. So it dropped more than 60% from its high point. And there are a couple of reasons that I could find. For example, they have some problems in China. So I don't know the exact details about that, but it seemed that they had some issues with the fact that the people there, the salespeople there, were not sticking to the rules. They were and they are investigating that themselves. And there's also an SEC investigation going. And that always puts pressure on a stock price. And besides that, they just posted very disappointing earnings. So I mean, I believe the latest quarter was 30% lower earnings than the same quarter last year. So those are all valid reasons for the stock price to drop significantly. But I mean, this is a huge reaction. So this might give us an opportunity to purchase this stock, which still shows us very healthy fundamentals for an interesting price. Well, so to determine what this company is worth, we have these three valuation models here: price earnings valuation model, discounted cash flow valuation model, and return on equity valuation model. Now the thing is, they show completely different numbers here. So what is going on? For example, this minus 30, what's going on there? Discounted cash flow. Well, if we take a look, go to the tab. The thing here is, free cash flow for this latest quarter was negative. And if you extrapolate negative free cash flow, then you get a negative value. Of course, the company does not have a negative value, but it uses the latest quarter, and so we can't really depend upon that particular valuation. So let's focus on the other two. For example, the price earnings valuation model. It uses the latest or the trailing 12-month earnings. So let's take a look at that one, which were, as I said, significantly lower than last year, almost 30% lower. So also the expected growth rate for this company is negative. So even taking all of that into account, so a negative growth rate expected by analysts, and even, I mean, they have this ridiculously high return on equity, right? We just saw that they currently have a return on equity of around 45%, and still analysts expect this company to grow at a negative, or actually shrink, in the coming 5 years. Even taking all of that into account, we still end up with a value of $64. Remember, we just saw that the current price is $41. So even in this really negative scenario, we still get a pretty high valuation relative to the current price. So this might be a very interesting opportunity, actually. Although one of the things, as I mentioned earlier, you shouldn't have any ethical objections to this multi-level marketing business. Return on equity valuation ends up even higher, and that's probably because it uses the return on equity to determine a growth rate. As we see here, this is the next 5-year earnings per share growth rate, which is negative, and this is taken from Yahoo Finance, where they poll several analysts who follow the company, and apparently they are very negative about the future. And the sustainable growth rate is actually calculated using the return on equity, and that's 15%. So it seems reasonable, and that's what the return on equity valuation model uses. As you can see, here's the 15% again. Takes a little margin of safety, so we actually use this 11% in the calculation, and we end up with $94, which is also much higher than the current price of $41. Now, just to sort of cross-check, we can also take a look at JITA. I've shown this website before, jitta.com. I looked it up, New Skin Enterprises. They have this dashed line, which represents the intrinsic value that they calculate. And what you can see is that they value it at around, let's say, $70 or $75 at the moment. Here you also see this massive price drop. So $75, also much higher than the current share price. They don't rate it as well because they put a lot of emphasis on the fact that, well, as you can see here in the JITA factors, earnings declined in the last quarter. So yeah, that's what I already mentioned, and that's why the score here is lower than in my spreadsheet. Yeah, so what this isn't a clear-cut situation, right? There are definite concerns about the malpractices in China. There are definitely concerns about the shrinking earnings. However, I already told you it's a multi-level marketing business, and generally once this pyramid of salespeople it has been built, um, earnings generally don't disappear overnight. So I personally think that this SEC investigation and their internal investigation with the practices in China, it will blow over, and this price drop might have been a huge overreaction. And these are the kind of opportunities that you're looking for as a value investor. So a highly profitable company which is actually selling for a ridiculously low price. Um, so if we, for example, so we have these two valuation models that we can use from the spreadsheet. We have JITA, which said it's around $75. That's somewhere in the middle of these two as well. So let's input this in this override field here. And then what you see is it recalculates here current share price $41, which means it's 82% undervalued, and which would imply that if you purchase it at the current price, you have an expected annual rate of return of 22%. That's a very, very good return. However, I have to urge you not to blindly purchase this stock based on what you just saw in this video. I'm just saying that it's a very interesting opportunity and you should do your own due diligence, but as far as I can tell, it's a very interesting company which is currently in a bit of troubled water, and it will probably blow over, and then the stock price will return. Can't say to what level, but probably eventually around $75 sounds reasonable to me, especially judging the fact that the stock has already been as high as $130. So thanks for watching this video. I hope you found it interesting to hear about this company. I mean, it was interesting for me to look into it because, again, it sounds like an interesting opportunity. If you have any stocks you want me to analyze, please leave a comment on YouTube. Also, I do these videos every week, or at least try to do them every week. So if you want to receive a notification when a new video is up, please click subscribe. I would really appreciate that, and you will be the first to get notified when a new video goes live. And also you can download the PDF version of this analysis for free in the YouTube description. So thanks again for watching, and I hope to see you next week.